I'm joined by Bhargav Dasgupta, MD and CEO of ICICI Lombard General Insurance Company. Congratulations, sir, on a good set of numbers. Now, if we have to particularly look at the solvency margin, which has marginally fallen down from a 2.10 to 2.5, and also when we look at the combined ratio, at least when it comes to a year-on-year comparison, that has seen a significant hike. Considering these two factors are there, what would you attribute them to? And how do you look to improve them then?
So, Riddhima, if you look at the combined ratio, and I'll use that to explain your solvency ratio question. If
Correct.
you look at the combined ratio for the whole year, we've had a significant improvement.
Yes.
From about 103.9 to 100.2. This, however, includes a very large loss that we've accounted for in the crop business. So the way the crop business gets done is that during the crop cutting experiment, as we call the crop cutting experiment, which happens with a bit of lag, then we get the data, and then only we know the full picture of the losses. So for the Kharif crop, the complete picture of the losses came through in Q4 for us this year. And unfortunately, it's been an adverse crop experience for us in the areas that we've written. So we've actually taken a very large loss hit in this quarter for the business that we've written in the Kharif period. Because of which the combined ratio for the quarter has increased from 97.1 last year to about 99.5 this year. But the moot point is that in spite of this one-time loss that we've taken, the combined ratio is still, just for the quarter, less than 100. So that's a good news for us. Now, the way the solvency is calculated as per the regulation in India is it's based on what is known as a gross claim model. So even if you have reinsurance, which we do, so the entire losses may not flow to you, but the solvency is calculated assuming that the full claim has come to you, and on a certain pre-assigned factor, you calculate the capital requirement.
Absolutely.
So which creates an optical swing in terms of the solvency margin. So that's the reason why our solvency is deteriorated from 2.1 to 2.05, even though the financial numbers have improved significantly.
Since you talked about the crop insurance business, we've seen significant growth in the company because of you undertaking this business. And now, by the end of the year, we are seeing underwriting losses. We are seeing a fall in the net premium to an extent that the loss ratio in this particular segment is as high as 135%. And same is the case with the government health insurance businesses too. Now, considering the experience that you've had so far in the crop and government health insurance business, how do you plan to kind of go about it in the future, in the next fiscal?
So the approach that we've been saying is the same approach that will continue. So if you look at crop, you have to look at crop insurance over a period. The basic nature of our business is that in certain year on a crop portfolio, you could lose money. But equally last year we made money on crop.
Yes.
So you cannot have a knee-jerk reaction to the business in 1 year. You have to look at the overall performance of the crop portfolio over a period of time, 4 to 5 years. Having said that, our approach to the crop this year was also still a bit more guarded, and we've talked about this in the past, simply because we saw pricing aggression. And in insurance, if you chase top line for the sake of top line, I think you repent in leisure. So we've been cautious about the growth of the crop insurance business this year, not because we didn't want to write that business, but because the pricing that we found on the market was very, very aggressive. And given that it's a tender business, we may quote at per our price, and we may not win based on what our pricing is. So that's what has happened for us this year. I think next year our approach will remain similar. We'll remain cautious from a pricing perspective. And in terms of the overall portfolio construct as a company as a whole, our crop portfolio is right now about 19%.
Yes.
We think even for next year, the percentage of crop will come down a bit.
By how much?
Difficult to tell you that exactly how much it will come down by, because as I said, everything is on a tender basis. So this is completely based on our understanding of how the market will play out, but it may not exactly work like that. So we may end up bidding less than what we are anticipating or more.
Is the case similar for government health insurance business as well?
Government health business is slightly different in the sense that at the time of winning a bid whether the pricing is adequate or not. It's not left to the weather gods. So you can be much more sure about the loss ratio at the beginning of the year in itself based on the pricing at which you quote. Now, what we found in mass health business over the last few years, I would say for the last 3-4 years, is that there's been extreme aggression on pricing, which is why we've gradually, had to leave that space. So if you see this year, our exposure to government health businesses or mass health businesses less than 2% of our total health portfolio.
Yes.
So, and we've not won a single deal because we've not found the pricing to be suitable from our perspective. And going ahead, unless the whole new NHPS scheme that is coming through comes in a manner that is sustainable, I think for the existing schemes that we see in the market, I'm not commenting on the NHPS scheme, but the existing schemes that we are seeing in the market, I think we'll remain cautious.
So when it comes to pricing, because you've had experience in both crop and government health insurance business, and you've said that clearly the pricing has not been profitable for the company in terms of the underwriting bit. So by how much do you see, the pricing should increase in percentage terms for crop insurance and for government health insurance businesses?
So there's no way I can give you one price for the whole market.
Compared to last year?
Every single state or every single cluster of states will
have a different pricing.
We'll see different pricing in terms of where we believe the pricing could have been, where the pricing has been. It's very difficult to say that we need 10% price increase or 15% price increase. What I can tell you is that on group health, we have seen group health, which includes let's say mass health.
Yes.
We have seen, in our estimate, 10 to 15% price increase at an aggregate level for the industry. Probably even a bit more. But even at that level, we are still selective because even that price increase, in our opinion, is not adequate. We need slightly more price increase. So that's where we are, and we'll see how that market plays out, because at least in the corporate segment, we've seen reasonable corrections, and we are now beginning to win back some of the accounts because the pricing is correcting.
So I'll hold on to the pricing bit for one more question. So we are clearly seeing a pricing pressure in the general insurance segment because there is no base price to which an insurer can reduce the prices, and that has always been a problem because there is a free fall of prices due to competition. Now going forward, which segments do you believe there will be an improvement in pricing so as to make business more profitable for you? And I am indicating more towards the motor insurance business or towards crop and health. How do you see the pricing move?
So while we've talked about all the segments that has not worked, if you see on aggregate, in spite of this, we've seen a significant improvement in loss ratio for us.
Yes.
Right? So as a company, we've had 3.5% movement on loss ratio. It's come down to 76.9 from 80 plus last year. So some of the segments obviously have done well. And the other, perspective is that in aggregate, we believe that the industry is moving in a positive direction from underwriting perspective. The year gone by, 2017-18, we've seen generally price corrections in most of the segments. So yes, while some segments still are underpriced, it was significantly more underpriced the previous year. So to that extent, it's a positive development in terms of pricing corrections. Now going ahead, do we see this sustain? We believe the direction will have to be sustained because if you see the overall industry combined ratio, it's still more than 110%. And that's not viable for the industry as a whole. So our sense is that most companies will have to get sensible about pricing, and we are seeing the trend going ahead. Now, going forward in terms of the segments, for us, if you see our loss ratio numbers, except for motor third party and crop, most other segments have shown improvement in loss ratio in the last year.
So the pricing correction there? Pricing
correction, we've been doing a lot of work with corporates on risk management. So when the pricing is very soft, what do? You can either leave the account or work with the client to see if you can improve the quality of risk, which is what we've tried to do. So we have a big initiative on what we call risk management services, we call it value-added services, where we analyze losses and go and give suggestions on how to reduce those losses through interventions. And on that, we are working with more than 800 corporates as we speak, and we are the pioneers in the industry. No one has, as far as we know, has done it at this scale. So those are initiatives that we are taking to control losses.
So taking that forward, your outlook on growth and on products, which segments do you see yourself focusing more onto? Considering you have been experimenting a lot, there is more in cyber insurance, there's the Ola in-ride insurance that has also come out. So how do you see the growth going forward? In what range, and from which segments do you see this coming?
So our view has been and remains that over the next 3 to 5 years, and that includes next year, the growth for the industry will remain between 15 to 20%. The fact that we've had a very low TP price increase, motor third party price increase, can create some headwind for the growth, but overall it should still remain between 15 to 20%. In terms of our approach, you've seen what we are doing on the digital ecosystem. I think we'll keep on finding new solutions to new risks as they emerge, and that's, I think, why we are seen as an innovative company.
So one last question. Every insurer has been allowed, for the agency network at least, the agents are allowed to sell one life, one general and one health insurance insurer's policy rather. So when we talk about inorganic growth, hypothetically, if you were to acquire a company, would you consider a merger or making it into a subsidiary of yours? Considering this would definitely be one of the considerations, the agency consolidation.
Since your question was also hypothetical, my answer can only be hypothetical, Riddhima.
Yes,
so
but
whenever,
a subsidiary
if
or
at all
a merger,
if something happens, we'll be able to tell you what the structure would be. As of now, it's a hypothetical answer that I can give you. I can't give you a real answer.
What would be the hypothetical answer then?
As I said, there's no point in giving you a hypothetical answer, right, Riddhima?
Thank you so much, Mr. Dasgupta.